Maverick. Noun, unusual person. A visionary, leader, go-getter, an independent thinker. They see the vision for their life and pull that future towards them with an unyielding belief that things can and must be better. They achieve what most won't. Innovative, influential, daring, and direct, with a remarkably high tolerance for taking calculated risk. A foe to the status quo. This is Passive Real Estate Investing with Mavericks. Your host, Neil Timmins, has been involved with over $300 million in real estate transactions. He's a published author, commercial property investor, and real estate syndicator. This show is for those who want to learn how to earn passive income through real estate investing. Now, here's your host, Neil Timmins.
On this episode of Passive Real Estate Investing with Mavericks, I sit down with Gene Trowbridge to uncover the ins and outs of real estate syndications. Welcome to Passive Real Estate Investing with Mavericks podcast, where we provide actionable steps for you to grow your passive income and become job optional. During this episode, you're going to discover the ins and outs of syndications, what you need to be asking a syndicator. For those of you who are new, I'm your host, Neil Timmins. I love passive income from real estate. Before I introduce you to today's Maverick, I want to make a request that at any point, if you like what you're hearing, give us a thumbs up or subscribe to the show to never miss an episode. And if you love what you're hearing, give us a written review. Plus, be sure to look at the description of this episode in the show notes. We've packed it with thousands of dollars in free resources. Now, today we've got the privilege to learn from a person with a 50-year career in real estate. He has been self-employed forever. He's never had a W-2 job. He graduated as a Minnesota Gopher in the 70s, found his way to California, got involved in syndication, and then pivoted into securities law. At 43, went to law school and has been working on syndications on the legal side ever since. So I would describe today's Maverick as someone who's passionate about real estate in a giant way and protecting investors and syndicators alike. I want to introduce you to today's Maverick. I've got Gene Trowbridge here with me. Gene, how are you?
Fine, Neil. Hey, thanks for having me.
I'm pleased you're here. Thanks so much for making the time. See, for the audience's sake, let's do this. Who are you? What do you do? Where are you from?
Well, I'm kind of a maverick. I got out of college and I went to sell some real estate, and then I became a syndicator for 20 years. And then when I was 43, I went to law school.
Okay.
And graduated from law school and passed the bar when I was 45, and have been doing legal work on real estate syndications ever since. Never had a W-2.
Wow.
Always been totally independent, and done a couple, all real estate, selling commercial real estate. Yeah. When I syndicated, we built self-storage facilities for build to sell, not to manage, and all that. And then I went to law school, and so and only wanted to be a securities lawyer. That's all I ever wanted to be in that part of my life. Yeah. So here I am.
You went to college in Minnesota.
I did. I'm a Gopher.
Yes. Just north of me, not far from here. And then after that, you moved after you graduated college.
I graduated from college in 70. Got married in 72, and then in 79 we moved to California.
Moved to California. Well, I'm curious, what prompted you were in the real estate business for a number of years before you decided to go to law school? What prompted that? There
was a situation where I was faced with the requirement of growing my company bigger than I wanted. The last year of my frenzy in being a syndicator, and I was raising all my money through the broker-dealer community. Mm-hmm. It was a pretty good deal. I sent out 1,676 K1s.
Wow.
With about 850 investors. Many of them were in 2 or more deals, and Regulation D hit the street, and Regulation D kind of forced me to do bigger deals. My broker dealer community wanted me to do bigger deals, which would have meant I would have had to have more office space, more staff. And I thought I was right about where I wanted to be in that career. And that's kind of the way I am. I have about 3 different times in my life, I've faced a decision to grow or retreat or change or something. And I've always chosen at that time just to back off. And like for my partnerships, I've had 3 partnerships in the law practice, and the most partners I've ever had was 3.
Yeah.
And I didn't want to grow bigger than that. Now today I have 1 partner. So.
Take me back to the very beginning. And I think it's fun to talk about where we started. Your very first commercial deal. What did that look like?
Oh, the first commercial deal, I sold a multifamily house, multifamily property in Minnesota to some friends that I knew.
Yeah.
Who wanted to invest. And then my first syndication deal was also in Minnesota, where I was doing both brokerage and syndication. And I syndicated an apartment building to some guys I went to college with. And then we syndicated an industrial building on the riverfront in St. Paul that was being used for a printing. And we actually did a sale leaseback.
Okay, yeah.
With the current owners and syndicated it. And then when I moved to California in 79, I had a Thomas Guide map book, but I didn't know anyone. And I thought maybe I wouldn't want to be a broker. So I just decided I would go full-time into the syndication world.
Tell me, you've been in syndication a long time, both from a person, I'll call it doing it from a real estate operator standpoint, to now the person who advises syndicators, helps syndicators put all of their structure together. What have you seen change over the course of your career in the world of syndication?
Well, one thing I've seen change is the securities laws. Really starting with 82 when Regulation D was passed, the securities laws continue to change to position the industry to promote capital formation, making it easier. Before Reg D, we knew we couldn't advertise, and we knew that we could only take people that were rich and smart, but we didn't know what that meant.
Yeah.
So in 82, Reg D came out and gave us the definition of accredited investors and certain rules, and that was a deal. And then the Jobs Act came along and gave us 506C, which promoted capital formation. And just really 2 years ago, the definition of accredited investor changed so that we have more people who qualify as accredited investors. And it's a recognition on the government part, the SEC and Congress, I guess, that a lot of small businesses get their financing through the private placement market. Neil, the last 12 months that the SEC reports on this, the private placement market was $2.7 trillion. It grew every year during COVID, and it's way outpasses the new money in stock offerings on Wall Street every year. So this is where, and what do they say? They say small business is 500 employees or less. This is where small business gets their capital after the bank helps them out.
Yeah, what you're saying is it's not just confined to real estate, not just confined to an office building or an apartment building. It's where small businesses can tap opportunity for capital to be able to grow. And then the other side of that is where investors can get access and place investments or dollars in an off market, in a non-stock market, call it environment.
Oh, that's absolutely true. The last figure I saw was about 35% of the 2.7 trillion was in real estate. So there's a lot of money in other things. And you get down to regulation, crowdfunding, and there's a lot of money in people developing their own brands of beer and in doing things that don't take very much money, but take some money. Right. And like small investors to go into it and And that's exciting. A lot of small business startups are using regulation crowdfunding.
Talk to me about, from a passive investor standpoint, what makes it appealing, and what type of person would be drawn to this? I'll call it a private placement, a syndication, whether it be in a business or into real estate. What makes it so attractive as opposed to, the more traditional, I'll use that in quotes, avenue of investing?
Well, I think Wall Street is a mystery. And in our business over the last 14 or 15 years, probably 80% of our business is in real estate, and 80% of that is probably in multifamily, and everyone's lived in an apartment building.
Sure.
Not, when I was building self-storage, not everyone in those days had rented a self-storage. So it was a little difficult, but everyone's been in an apartment building, or they've had a job and they've worked in an office building. And so they're comfortable with the assets, and it's easy in, easy out. You don't have to have a stockbroker. You can make your own decisions. For the sponsors like you, doing a Reg D offering is kind of an easy startup, and then you can go out there and talk to people that you know. It's really a personal business. I have learned in my career that you have an asset and you have to manage the asset. And sometimes the asset's a long way away, and so you hire a property manager, but you're not spending all of your time managing the asset. Primarily, you're managing your investors. It's a database. It's a people business, and most the passive investors, and I don't talk to a lot of them. I have some ideas on how they should approach it, but most of the passive investors are investing because they know who is behind it. It's not like they know the board of directors of Twitter, and so they decide to invest in Twitter. No, they know Neil, and they know his team, and they know the geography and the type of properties that you do, and that's very attractive to them.
I'm curious, you see a lot of syndicators. You work with a lot of folks. So from a passive investor standpoint, based on what you see, what should a passive investor be looking for when they're dealing with a syndicator? Because I'm sure you've seen a wide range, some who do it very, very well, and some who, leave a lot left on the table, if you will, could operate probably a little better.
A recording on this on our YouTube channel. It's the 4 questions that a passive investor should ask. And you'll be surprised when I'm through with these 4 questions how non-asset specific they are. I think the first question a passive investor should ask is, hey, Neil, you want $50,000. I think it's a good investment. I'll give you the $50,000. But Neil, what happens if something happens to you?
The succession question, yes.
Yeah, continuity. That's a showstopper. If Neil is the only one running this investment with his industrial properties and 50 investors, you just don't invest. I have been a substitute when I was syndicating. I was a substitute 7 times for companies where they had an individual manager, and something happened and that manager was not able to continue. And only once was a death. There were 6 other events that happened.
Wow.
That took the manager out of being able to make decisions and manage the people's money. So that's the number 1 question I think they should ask. And the number 2 question is, Neil, have you done this before? That doesn't mean you should never invest with a first-time syndicator, because right. Neil, you and I, when I was a syndicator, would have had to answer that question at one time. No, I haven't done this before, but here's my background. Here's my education. Here's right. my training. Here's what I can do, and I think we can do this. And then the people that know you the best and know that you see opportunities out there who'd love to take part of those opportunities, right. will invest with you in your first deal. So you need to get off of that. So the next time someone asks you, and say, hell yes, once. And that's all I care about. And the third question I think a passive investor should ask is, Neil, are you going to have skin in the game? Are you going to be investing
Yeah, I love that one.
I used to think that was only cash. That was the only answer to that question, is how much cash do you put in? But over the last 10 years, I've come with a pretty healthy admiration for the fact that the syndicators sign the mortgage. And there's a lot of risk associated with signing the mortgage. So not only do they put some cash in the deal, but they also step up to the plate with their personal wealth and assuming personal risk. And I think that's important. You wouldn't ever syndicate a deal that you wouldn't want to buy yourself if you had all the money.
Correct.
I mean, all the interviews I've done of my clients over the years, how'd you get started, Neil? And They always give me the same question. Hey, I found a property. I didn't have enough money to buy by myself, so I thought I'd present that opportunity to friends and family, if you would, to get started. I think that's very important. And then the last question they should ask is, Neil, I'm actually, as we record this tomorrow, truthfully, I'm turning 75.
Happy birthday, my friend.
So Neil, if I need liquidity, how does that work in your offerings? Mm-hmm. And Neil's going to say, well, we have a professionally drafted operating agreement. And Neil is going to have read that. And so Neil is going to say in Article 11 and 12, we talk about the two types of liquidity, voluntary and involuntary. And let's go through that together and see if that satisfies you. So that's where you start. Now the question is, what are you investing in? And, passive investors are at least supposed to be sophisticated, which is a crazy word, but that, through their training, their advisors, their business experience, they have come to a point where they can understand what the hell the deal is. They read the documents and they can understand it and maybe even understand the risk. So I think you should invest in something you're sophisticated in. I have people, and maybe you've interviewed people that for a long time are doing multifamily and they've switched to mobile home parks. Yeah. Well, I don't even know if the sponsor is sophisticated in mobile home parks. I've been to a lot of training on mobile home parks because I had a very big client in the mobile home park industry, and in one of their trainings, they took us through a video of the factory that makes the coaches.
Yeah. And
that's a little different than how you build an apartment building. And so I think you kind of need to know that stuff. And then, so for my passives, if you've been investing in multifamily all along, and here comes Neil, and Neil says, well, we're going to buy a multi-tenant industrial building, tilt-up concrete. Oh, what do they know about that?
Correct.
They should get educated in there. I don't think it's the syndicators' responsibility to educate them. There are plenty of people like you out there who can train and educate investors so they can be sophisticated in whatever product type they're looking at investing. But just don't run off and do it if you don't know anything about it.
No, and I think you gave a good example, a multifamily to mobile home park, and they are night and day. Although they may be housing, right? Yep. The businesses thereof are completely different.
Yeah, people are saying, well, this is the new low-income housing, mobile home parks. Well, not necessarily. It depends upon what parks. I'm out here in California, and there are parks that are Ocean View.
Yes.
The lot is $3 million. And you can imagine the coach is substantial.
Correct.
But if you're in no offense, if you're in Ames, Iowa, on the outskirts, it might be a 100-unit park, but it might have a cyclone fence around it, and that's it. I don't know.
Yeah, you're spot on. They're totally different. And everything is different there. Yeah. What I loved about your 4 questions is that they're not asset specific. They're the foundational 4 questions that one should understand before going to the next step.
Well, you know why? Because what's the definition of a security? An investment of money in a common enterprise, the LLC, with an expectation of profit through the results of the promoter, through the syndicator. That's the most important part. So let's figure out what's going on with the syndicator. And I didn't even ask about track record.
Right.
Track record's another thing. And in the private placement market, most PPMs don't have an elaborate section on track record. If they have anything, it's a narrative about the deals that they've done.
Correct.
But they don't have 27 profit and loss statements from last year. So I think you should probably ask about that. But that's getting a little more in depth than I need for the individual questions. And one of the things that I didn't say is our firm has a policy that we won't do the paperwork. If Neil comes to us and said, I'm going to be the manager of this entity and I'm all by myself, I'm not going to do it because I don't think it's right for the investors. I think it's too much risk. And today, a lot of lenders, have you heard of a springing member? A lot of lenders, if there's just Neil, will say, okay, we need a springing member and you have to hire a corporation that's in business forever who will be the springing member. And the issue is when the last member of the manager can't perform, this corporation steps in and runs it all. No one wants that. No one wants that. So we need to, had one guy who hit his head skiing in Park City and became a quadriplegic, but he was in traction for a year. Someone had to step in and take over that. And I happened to know the guys, so they came to me. So
tell me, when you see, or maybe what should passive investors be asking relative to how a syndicator is borrowing? We're in an environment where rates have changed very quickly, very fast, and there's a lot of conversation and concerns surrounding banks as a whole.
Sure.
What should they be mindful of?
Well, I think one of the things they should be mindful of is the term of the loan. It's great to get a 25-year amortized loan with a 5-year term, I guess. Unless at the end of the 5 years, you can't refinance the property. Right. See, this is where we are now. With all the bridge loans and everything that's gone on in the last 2 years, there are relatively short-term loan maturities out there. And what's the alternative at the end of the loan maturity? The existing lender is not going to refinance it. We just know. Maybe they could, whatever, but they're not going to. They're not going to be the last lender of resort. So that's not going to do it. So can we find a new lender to lend? And the issue there is, well, what's happened to the NOI? How has the value changed? And compared to the loan to value that the current marketplace is looking at and the debt service terms that the current marketplace is looking at, can this property be refinanced? Yeah. And if it can't, what we're seeing right now is we're seeing capital calls.
Correct.
So one of the beauties about the multifamily business on bigger properties is Freddie and Fannie institutional financing, because they're fixed rate and they're long term, and you don't have to worry about that. But a lot of deals have been done on these bridge loans, and we don't even have to wait for 5 years for some of the problems. If I were a passive investor, I'd ask about the interest rate cap that the lender requires at the start of the loan. The lender requires that you put extra money in the bank so that it's available when interest rates go up, that they can get the payment from you, but go into this interest rate cap reserve and pull out enough money to make sure that the full payment has been made. I mean, we've had a period of time now where rates have gone from 3 to 6, and they only bought an interest rate cap to take them to 5. And so that's where the capital calls are happening today. They have to replenish the interest rate cap, and the lenders don't know. So it might be an interest rate cap that has to cover to 8. I don't know. But so now we're doing capital calls. So I think the debt is, market rates are market rates. Mm-hmm. Even today, These are spectacular interest rates for long-term assets. You're not quite as old as I am, but the first home I bought had a 13% mortgage on it.
Yeah.
I mean, we're talking 5 or 6. That's a steal. And we were in nirvana when interest rates were, 2.25% and 3%. That's just absolutely unbelievable. So now we're back to normal, and it's a shock. Okay. And so here's another thing I think it's interesting. How do you know that the sponsor can handle the risk? And so in the last 5 years, let's talk about risks.
Yep.
That when I wrote the PPM, I didn't write anything about these risks. One was COVID. How would you have known 5 years ago that all of a sudden there was going to be this disease and you couldn't inspect all the units, and the government was going to come in and say people didn't have to pay rent and people couldn't be evicted? How did you know that? And what's the sponsor's capability of dealing with that risk? Do they have lines of credit? Do they have relationships with their investors where they can be successful making capital calls? I don't know. And then the other one is, certainly in 2020, we didn't write risk factors that the interest rate was going to double in 6 months.
Correct.
So, and that's one of the problems with being a syndicator is the risk is always greater than you think it is, because there's always something coming down the pipe that you cannot realistically foresee. And that's not the syndicator's problem that we didn't, or my problem as the attorney, that we didn't write COVID and interest rate risk into the deals because it wasn't foreseeable. So I think we need to talk about things that might be foreseeable. I've been in the business during all the major crashes, 78 and 86 and 91 and 2008. And there's always been money from passive investors to invest in every one of those crashes. It's not that there's blood on the street, but there's always investing opportunities. And can we find a sponsor, a syndicator who identifies those opportunities and provides the opportunity to the passives? And you might have heard me, I haven't used the word sell. I don't think that's what the syndicator does. A good syndicator finds a property, finds a business. The last crowdfunding deal that Jonathan did was a distillery. The guy was doing pretty good selling the whiskey that he was making, and he wanted to go bigger. He wanted to raise $2 million for a distillery. Well, okay, find something that's good. And then all the people who had been buying his booze from him thought maybe this would be an opportunity to be involved in the distillery business. We don't have to sell anything. We just provide people with the knowledge that there's opportunities out there that we've identified, and we're going to make them available to them.
You've been through, as you mentioned, I mean, every cycle and multiple cycles. And oftentimes when things are, let's call it the darkest, the greatest opportunities are presented, but it does take somebody with, guts and foresight to be able to identify that opportunity and then have the intestinal fortitude to go through the middle of a cycle or the tail end of a cycle to be able to get out of it. And
one of the things we're seeing now with financing is I'm doing some all cash deals.
Sure.
So we're going to buy for all cash. We're going to hold, and when this market calms down, which it will, I just heard this morning that inflation is down to 5%, and the 10-year T-bill dropped from 3.5 to 3.31 overnight. So that's going in the right direction. And at some time when the market for financing is good, we refinance and give the investors a good portion of their money back. On smaller properties that are owned by what I'm going to call mom and pops. Anyone remember what an installment sale is? You give them 20% down and they carry the financing, and maybe in 5 or 7 years, when their refinancing market is okay, you refinance it,
Right.
pay them off, and they spread their taxes out. So that's good. And then doing capital calls.
Yeah.
Doing capital calls to raise an extra $1 million so we can get a new loan when we need it at a smaller principal balance to offset the higher interest rates, and we'll be fine.
I want to ask you a question about financing, and I'll give you a free pass. You can punt on this question. So you mentioned Fannie Mae, Freddie Mac, the ability on an apartment to be able to get very long-term fixed rate financing backed by Fannie Mae, Freddie Mac. It is the only asset class where that exists. The federal government steps out of offices and industrial and every other asset class that's out there. TREP has indicated there's about, I'm rounding, $2.5 trillion coming due over the next 5 years. So fully 46% of all commercial loans will come 100% due and payable between this year and the end of 2027. And as you touched on, which I agree with, there's a whole bunch of people not going to be able to refinance. It is going to be a problem, either through capital calls or, in today's environment, you could probably, many assets could just be sold and recoup some dollars and cents without too much of a problem.
Right.
I'm wondering, if things turn particularly challenging for the environment, what is your opinion on the government backstopping with a Fannie Mae, Freddie Mac product for all other asset classes?
Well, I'll punt on that one, but there's another part of that question. Where is that $2.4 trillion where are those loans? They're in regional banks.
Correct.
And what's happening on the regional bank's ability to borrow today since the first bank went down up in Silicon Valley?
I literally, right before we got on, I write for a publication. So I just finished writing the article that ultimately indicates that there is a tremendous run on small banks, on community and regional banks, for their deposits to move them into banks that are too big to fail. And so what's happening in these small banks is their cost of funds will increase. They're going to become less competitive as it relates to lending, and big banks are going to become more strengthened in that position. Whether they fill the gap in small loans,
they're not going to.
They're not going to. No.
Right. It won't reach their risk parameters. And that's very interesting because the little banks can't make the loans. So what are you going to do? As you said, maybe there's going to be a sale. Maybe there's going to be a pay down. I did run into that crunch in 1981 with, at the time we were building storage facilities, and because we were a merchant builder.
Sure.
Buy the dirt. Let's pour the concrete. Let's get it 20% occupied and let's sell it to bigger operators.
Yep.
And we were doing it on uncovered construction loans. Well, 81 came along and properties started going into foreclosure, and the banks that we were looking to and public storage stopped buying properties. Our first marketplace was I had a lot of orange paint. Yep. I'm selling it to public storage, and they decided to stop buying new properties. So now we're sitting there with uncovered construction loans, and we couldn't get the bank that had the construction loan wouldn't be the permanent financer. So we actually had to go out to different banks and get mini perms, and we had to bring in more money to pay down the balance of the construction loan to get a mini perm that was less than the construction loan, or we would have lost the properties. And there was some gnashing of teeth when we did that to our investors, but that's the way it is. That's kind of interesting when we use the word sophisticated. Does an investor need to pay attention to all this debt conversation we're having and understand that if something goes wrong, there may be a capital call? Yeah. So if you put your last $50,000 in a deal and there's a capital call, there might be some penalty, especially if you're investing. And we've run into this. If you've invested in your IRA or passive investing, you put your money in your IRA into owning your share. And here comes a capital call. Without being a prohibited transaction, the only money that can fund the capital call has to come from one of your IRAs. It doesn't have to be that one. It could be another one. So you either have to be able to be in a time in the calendar year where you can make your deposit into your IRA at that time, so there's enough money in there to make the capital call, or you can't just reach in your pocket and do that. So what we've had to do is we've had to modify the operating agreement and let the sponsor sell more interests. So an IRA investor can't make the capital call, but the 10% that they need to invest, we can issue a new series of Class A interests, and they, as an individual, own that. So there's enough money that goes in the bank account to handle the interest rate cap property. But that's kind of interesting. And do you want to, since I'm on the topic of IRA investors, if you're an IRA investor that's 75 years old and the sponsor comes to you and says, we've got a 7 to 10 year hold, okay, is that a good investment for your IRA? What happens when because at 75 you're taking mandatory annual distributions? Well, you better have some money left in there to do that. So I think that's one of the things I think I get resistance when I put in the offering questionnaire a question about the investors, the passive investors' age. I get resistance from my clients, but I have to tell them situations where it'd be a good idea to take that into consideration when you're accepting an investor's money, because, Neil, you've got their money.
That's
You're
right.
a syndicator. You've got their money. That's what they all think. You've got your money. In my world, it was in cement trucks until it was poured concrete, but we didn't have any money.
Correct.
You don't have any money.
No, it's employed.
But they think, they think you have their money, and so you've got to be able to deal with them like that. It's the world of passive investing is good, but I will tell you, in this cycle, which I'm going to say started in about 2012, we really haven't seen any major problems in offerings, even through the COVID and then through this interest rate deal. Now it may be coming up, but as you said, you can always sell the property. More than likely, the loan to value ratio and increasing values is still enough to sell the property, and at least.
In today's environment, there's a lot of demand still.
There's more money than there is properties.
You're exactly right.
I will tell you that in October and November, our stream of new syndications that came into us really dried up. But December picked up, and this month we're sitting here in April. Looks like it's just going to be a standard. In a standard month, we do 15 to 20 deals a month.
Wow.
And in October, we did 2.
Yeah, quite,
Okay.
Very, very different. Well, it's the Treasury interest rates have come down over the recent, handful of months, and it seems like that. And then, you roll into a new calendar year. Everybody has there's a lot of positive out there and a lot of people looking for opportunities. You're right. Tremendous demand. And I think you made one good point. Should passive investors. Yeah.
That's all.
Touche. That's fair. One good point that I'll comment on right now, that a passive investor, should they know about debt and what's taking place and the risk associated with that, they should know enough to be able to ask the questions to the sponsor. Doesn't mean you have to have the understand how everything works, but be sophisticated enough to know some of the risks that are associated with it and to ask those questions, because you'll find in a hurry your sponsors who are deeply understand and have thought through the risks, and those who have not.
Well, that's right. And in the property package, that you put together and all my sponsors put together, whether they call it the offering memorandum or the investment summary or whatever, and a lot of it's in slide decks these days. Yep. There's a page in that slide deck that gives the terms of the financing. I'd go right to that page, and if I had any concerns, I'd ask questions about that. It's not hidden. Right. It shouldn't be hidden. It's right there. And so the question, what's your strategy 5 years from now? Because good bankers underwrite properties twice. They underwrite them today. Can we make the loan today? Blah, 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 blah. And then they say, okay, 5 years from now, we need to get paid off. Let's underwrite this property, assuming what is going to be there 5 years from now, our assumption of loan to value, NOI, terms of interest. Will there be anyone in the Western world who will refinance that loan at the end of 5 years? And if we don't think that's possible, we're not going to make it today, even though it qualifies today.
Correct.
So that would be my concern in office properties. We do some office properties, and we always have the discussion of vacancy rates. Downtown New York, downtown San Francisco, whatever. Those aren't the type of office properties that I do, but I might do a 15 or 20,000 square foot office property in Orange County, Anaheim, or whatever. And the question is, well, who's going to be in that building? And it's all second tier tenants. Correct. AAA tenants in those buildings, and so that's a good question. Office buildings, I think, are of all the product types today, are most susceptible to vacancy. I used to think that it was going to turn to retail, but there's I haven't seen that, especially single tenant retail. I haven't seen that so much. In fact, I have a client who's making an inroad into converting high-rise office buildings in major cities to Class A apartments.
Sure. Yeah, to repurpose them. Yeah.
Dallas, Atlanta, all absolutely gorgeous buildings that are maybe 20 years old, and there's not enough tenants for them. So they're going to go in, they're going to leave retail and a couple floors of office, and then they're going to go up. I mean, that's putting a lot of bathrooms in, right? That's a lot of plumbing and
it's a lot of work to repurpose it. Yes.
But that looks to me and his investors to be a pretty good deal. But I think you have to be risk conscious of that.
There's some other layers of risk associated with that type of project.
He's got one that's right across the street from the Rock and Roll Hall of Fame.
Okay.
Yeah. Great.
Let's do this. I want to move on to the final segment, what I call the final four. What do you think holds most passive investors back from hitting their personal next level, whatever that personal next level is, as it relates to investing?
Well, I'm trying to figure out what two things are going through my mind. One would be becoming a syndicator, and another one is having enough money now that they can go and invest on their own. Because you just buy more passive deals. I have people call me that are in 20, 25, 30 passive deals. And then they say they want to be a syndicator. And when they ask me that question, I just let the silence take over. And I come back and say, why? Why would you want to do this? It's obviously working for you. Just invest in more things and book coupons. And then if you're not happy with what that is because you don't have control, and now you have enough money, go buy something yourself and see how miserable that is. So I don't know. That's my best answer because I'm not sure go to law school. What the hell?
What are you most passionate about outside of real estate?
Outside of, I'm passionate about the time that I have with my family.
Yeah.
As I said, I'm a little older and we've been married 50 years and I need to spend, we have a daughter who's 41, and I need to take some time off, although my hashtag, Neil, is not retiring, but but I need to spend some more time with my family. And for my birthday present tomorrow, I'm giving myself a 1 year of physical training.
Oh, good.
And next year, getting back in shape. I've had some surgeries related to all the half marathons I've run in the last 15 years, and they're all healed up. So I need to get back up there. So that would be it. I love music. We go to a lot of concerts, and Kay and I, we've taken some major trips in the last 4 or 5 years, and this year we've just decided we're just going to go on 3 or 4 day trips around the country. Last year, the trip to Italy, carrying the luggage, was a backbreaker for me. It was too hard.
Yeah. Your favorite book?
My favorite book is The Shack.
The Shack?
The Shack, yes. I've got it over here, but I can't tell you what the name of the author is, and that they made a movie out of it.
Okay, I recall it now. Yes.
Yeah, The Shack. That's a real eye opener for your look at the spiritual.
Mm-hmm. Yeah.
That's my favorite book. I've given that book away a lot.
What's your favorite way to make an impact in the community?
That really hasn't been a goal of mine. Over the years, I've been involved. I'm involved in the State Bar Association, the local bar. And then I was, for 40 years, I was Senior Instructor for the CCIM Institute, and I just retired 2 years ago.
Yeah.
And that really was what I was doing, is helping people get educated and hopefully have a successful career in real estate, which is what I have always done. And it's a wonderful career if you want to be independent, be a maverick.
Yeah, I think that's a wonderful way to make an impact. Well, this year we launched the Maverick Vault, a collection of resources available to our listeners. And I understand you're making a contribution. So tell us a little about your contribution, the PDF book.
Yes, I have a book. It's called "It's a Whole New Business," and behind that title is a discussion that when you get into the syndication of real estate or anything, it's not so much the asset. It's the securities laws, it's the financing, it's the entity structure, it's the fiduciary duty to investors. And the 4th edition is out, and it was updated because of the last changes in the security law. Chapter 5 got updated, and you're going to have a QR code that's going to allow all your listeners to download a free PDF of the book. The book is available on Amazon, and I actually have an audio. Last year, I went into the studio and recorded the book, and kind of interesting. I've read the book many times and I've edited it many times, but reading it was really boring. And so I'm reading it and sitting in this little room. It took me 16 hours to read it. And so I'd get to a point and I'd say, yeah, that's fine, but here's what I think about that. So it turned into more of a monologue than just a book. And I've listened to it and I find it very interesting. And the people, the 2 people that bought it, I found it interesting.
Both of them, huh?
Both of them. One more, I can retire. So that's available. So you'll have that, and your people get a chance to read that. And that'd be wonderful if I could contribute that to your vault.
Yeah, that's why we appreciate that contribution, Gene. Thanks so much. You guys can get that at www.themaverickvault.com, and the QR code will be there for you to get that download. Gene, I appreciate you taking the time to come on and share so much. You've got so much wisdom and experience in this whole world of syndications and investing and multiple asset classes, and have seen just so much. So I sincerely appreciate what you've shared with us today. Thank you for your time.
Well, you're welcome, and thanks for taking your time that could have been used for someone else to listen to me. I appreciate it.
You bet.
So,
Listeners,
good luck
pat
to you,
yourself
Neil.
on the back.
Thanks so much,
You guys have
Gene,
made it to
and
the
I'll see you
end of the
soon.
show, and most people never finish what they start. If you receive value from today's show, be sure to share it on LinkedIn, your Facebook page, or your social media platform of choice. Subscribe to never miss a valuable episode in the future. And if you found value in today's episode, give us a thumbs up with a positive review. If there's a particular topic you'd like to hear about, well, I want to hear from you. Shoot me a message on LinkedIn. The link to my profile is below in the show notes. You can connect with me there for more valuable content.